This podcast is for education purposes only. Please stay tuned to see disclosures at the end of the presentation or see the link to my disclosures in the show notes.
Welcome to Not Your Parents' Financial Advisor, the go-to financial education podcast for affluent millennials. Join your host, certified financial planner professional and millennial Alex LaRosa, as he breaks down expert financial planning tips for the younger generation.
Hi, everyone, and welcome back to episode 4 of Not Your Parents' Financial Advisor. I'm Alex LaRosa, your host, and today we're going to do things a little bit differently than I did for the first 3 episodes of this show, which was just centering around, one specific planning topic or something to do with the affluent young professionals. Today, we're going to talk about a few different things. One, I'm going to introduce a new segment, which I call, your tax planning tip of the week, which is just something from my bag of knowledge that has to do with tax planning and being more efficient in your taxes, specifically for you young high earners. Then we're going to go through an actual case study that I wrote dealing with a young high earning couple, right? Or Henry's couple, right? High earners, not rich yet, which is exactly what the show is targeted towards. And I'm going to walk you through where they were. I'm going to share some graphics for, those of you watching on YouTube. Those of you that are listening on the podcast, you can find the exact case study in my show notes. There's a link to it. But we're going to walk through that and just see, how we were able to help them, where they started, what the process, and kind of how they ended. And then I'm going to end again with the second iteration of reacting to financial advice online, where I'm going to show a video of something I found online that I may disagree with or have a different opinion on and kind of discuss it. So why don't we go ahead and get started with your tax planning tip of the week. This week, I'm going to talk about HSA accounts or health savings accounts. Now, this is a very effective type of investment account, and it's specifically for those who have high deductible health insurance plans, right? And it allows you to deduct money out of your paycheck and put away money into this account that can, grow or be saved or be invested, and you can use it to pay for healthcare expenses. So it's the only account out there known as that has the triple tax advantage, is what they call it. So what that means is the money you put in each year is deducted from your income, so it lowers your taxable income, thus lowering your taxes. It can be invested, like I said, in most cases, and grow tax-free. And then when you use it for healthcare expenses, it can be withdrawn tax-free. So it's the triple tax advantage. The current contribution limits for a family in this year is about $8,300. For an individual, I believe it's somewhere around $4,200 or $4,300 per year. So you can deduct it. Make sure, if that is available to you, you can ask, I would go ask HR, I'd ask your employer. Make sure you're utilizing this because you don't want to be leaving, money on the table. This is something that is very effective because at the end of the day, all of us are going to have health expenses at some point in our life. That's just the nature of life, especially when we get older. So even if in some miraculous case you don't, it just turns into basically an IRA or an individual retirement account where, if you take it out for non-healthcare related expenses, it's taxed as income, just like an IRA or a 401k would be. So now the biggest mistake that I find young people making or, affluent professionals making is they're using their HSA accounts in the years that they're working for healthcare expenses. So they kind of have that mentality of, the flexible savings account, which is a different type of account, where if you don't use it, you lose it, which is not the case. So the biggest benefit of this account and the most power that it has is that tax-free growth. Just like with a Roth IRA, just with the 529 plan, the tax-free growth is where you make your money. That's where you get your value. So taking money out every year to pay for something eliminates that advantage. So if you have the ability to pay for your healthcare expenses out of pocket, and if you're, a high earning professional, you should have that cash flow to be able to pay for it out of pocket. Let your HSA account grow tax-free for as long as possible because, as I mentioned, we're all going to have higher healthcare expenses when we're older in retirement. So build that up. And when you're in retirement, you no longer have a paycheck. Your assets become your paycheck, but having that account that you can use tax-free during retirement is a huge advantage. It will set you so far ahead because one, we talk about, I talk about a lot with people that are getting ready for retirement. There's a thing called IRMA, which is how much you make in retirement dictates how much you pay for Medicare. So if you're taking money out of your IRA to pay for healthcare expenses and other things, well, you're increasing your income. That's increasing the amount that you're going to pay for Medicare. So you have a tax-free account that you can use to pay for that at the time. I mean, that's a huge advantage. That's a huge advantage. So if you have one, utilize it, max it out if you can. I would do, kind of in the line of things, I would do up to your employer match for your 401k. Then I'd look into a Roth IRA. And if your HSA is there, use that as well, right? Before you kind of move on to any kind of a after-tax account or a brokerage account or anything like that. Roth IRA, HSA, 401k, very important, very effective tax planning tools. So now I'm going to move on to the second part of the podcast, which is where we're going to go through a case study. Now, this is a real case study that I wrote that had to do with real clients that I work with. And, for obvious privacy reasons, I'm going to change their names. So these are not their real names. And I altered the situation slightly so it doesn't, give away too much. But the title of the case study is called Helping High Earners Plan Cash Flow. So a few months ago, a couple approached Bluebell Private Wealth Management, the firm I work for, seeking assistance in establishing a financial plan. Now, they were in their mid-30s at the time, and they had not previously sought any financial advice, and they had managed their finances on their own. So because this was their first instance in working with a professional advisor, they realized the importance of having a comprehensive financial plan, and they sought our expertise to help them achieve their goals. So quick client profile. They're in their mid-30s, as I mentioned. They have a combined annual income of $232,000. Their expenses, per year are somewhere around $108,000. And they have a net worth of about $316,870. Their net worth was mainly made up of 401ks and the equity that they have within their house, plus a little bit of savings in the bank. So, just a quick overview. To maximize tax efficiency and annual savings, leading to an improved cash flow and probability of success, as a part of the onboarding process, we gathered all relevant information and input it into our financial planning portal. Here is an overview of their current situation. So I'm going to flash a little portal snapshot on the screen here for you, those of you watching on YouTube. For those of you listening on the podcast, you can find the link in my show notes. But essentially, plugging everything in, this screenshot shows the balance sheet, shows their net worth, it shows their effective tax rate. But on the top left, what we see is called the probability of success. And what that is in our financial planning system, it runs what's called a Monte Carlo analysis, which takes 1,000 different market simulations based off of the information that we feed it. And it gives you, out of those 1,000 scenarios, what percent of them end with you dying with money, right, rather than without. So for these people, 44%, so about 440 out of 1,000 times, right, is a successful retirement for them. So that's not a great number, not terrible, not great. For young people, it's always going to be a little bit lower. Usually our accepted rate for the Monte Carlo to say, hey, this is a success and we can plan to kind of fill in the blanks is somewhere around 80, 85%. So we'd like to see that get higher. So it's not unusual for when I come across, high earning professionals who are young, that they keep most of their assets in pre-tax 401ks. That's sort of automatic. So that's all they know. They're contributing up to the match. They're putting away every paycheck. But I find always that, there's opportunities for automatic savings elsewhere to kind of diversify the type of savings accounts that they have. So what I do then is I take a look at their cash flow using what I'm going to show on the screen here is a cash flow waterfall picture, right? So we can kind of see here their salary, as I mentioned, is about $232,000. On the top there, we see their expenses around $108,000. That's broken out into living expenses and housing expenses. Below that, we see their estimated tax payment, which again is broken out into federal, state, and FICA. Then we look at plan savings. So that's coming from what we know from them. They were contributing 6% per paycheck to their 401k. So their plan savings was about, $9,700 a year. And then we see the unsaved, the remainder at the bottom there, which is a little under $60,000. Now, for our purpose is always to be conservative in planning. We always assume that that money is spent, that that's money that they just, it goes to vacation, it goes to unknown expenses, unforeseen expenses. But we always see that if there's a big chunk in there as a possibility to automate some of the savings and increase our savings. So in this scenario, their combined income, right, was as we mentioned, was $232,000. So here were our recommendations when we were looking at this cash flow model and looking at all the other information that we had. 1, increase savings. That's pretty obvious. 2, establish and optimize a backdoor Roth IRA for each individual. So going through their information, we found they had no traditional IRA money and they make too much money to contribute to a regular Roth IRA. So that lets us know, hey, this is a great candidate for what's called a backdoor Roth IRA. I've done videos on this in the past. You can go find them. If not, we'll definitely talk about this in future episodes. But that's a very effective strategy for your young high earners that do not have any traditional IRA assets. And then we also want to establish a taxable joint account, so a brokerage account, right? So for some of that after-tax savings and diversification. To start, we always find that people underestimate their expenses. That's just what we do. So instead of planning to save the $60,000 that we found and the unaccounted for in the cash flow, we're going to start with somewhere more conservative, somewhere around 40, right? That gives a little bit of a cushion in case they underestimated their expenses. So one of our early recommendations was for this couple to complete backdoor Roth IRA conversions annually. This year, that's $7,000 for those under 50 per year per individual. So a total of $14,000 can go towards that. And then we also suggested that they start making an automatic contribution to the taxable joint account, roughly of about $2,250 per month. So think about it like $1,125 each. We have that coming out on the first of every month. So it comes, they get paid. It comes right out of their bank account into their brokerage accounts, invested. They don't have to think about it, and the money can't get spent. So what did that do? So after implementing these strategies, I'm going to show their new cash flow model, which now shows 1, higher plan savings, which we knew. We see the bottom there. We see the spend unsaved cash flow is now a little under 20. That's that cushion. But we now have a net cash flow saved beyond just the plan savings of another additional $27,000 per year. This increased their savings rate to 24.4%. And if you've listened to my previous episodes about savings, that's a great savings rate, right? You're somewhere between 15 and 25%. So they're right on the high end of their savings rate. With an excellent diversification now because they're saving in their traditional accounts, they're saving in a joint account, and they're saving in Roth IRAs as well. And additionally, they still have that $20,000 a year buffer that was unaccounted for. Now, showing the first screen that we showed on this, just making those changes has increased their probability of success from 44% to 91%. Huge success, right? So that was a real life example of how you can plan as a high earner to just do some automation, increase your savings rate, and take advantage of some different accounts that can kind of diversify your savings, not just in the pre-tax. So you're not caught with just a bunch of taxable money in retirement. Plus, investing in a joint account, right? That can kind of act as that intermediate goal account because it's liquid. It's subject to capital gains tax rates, but it's not locked up like a retirement account. So that was our cash flow case study. And I'm planning on doing, more case studies in the future of clients that I've helped in the past that fit the profile of people that, I hope are listening to the show. All right. So the final segment of today's episode is going to be reacting to financial advice that I find online. So I'm going to throw up a video, and today's video comes from the one and only Dave Ramsey. For those of you not familiar, Dave Ramsey has been in this business a very long time, the financial literacy business. He has a show, several books. He's online all over the place. You'll find him on TikTok. You'll find him on Instagram. But I'm going to go ahead and play this clip. All right.
The borrower is slave to the lender. What happens to us is we go to school and they give us a free pizza, so we sign up for our first credit card. You can't go to college without a student loan because you can't be a student without a student loan. That's federal law. So we sign up for that, and then we graduate from school, and now we've got the first big boy, big girl job, and we're tired of driving that old hoopty, so we get a car we really can't afford. And then people start saying, oh, you've been married 20 minutes and you haven't bought a house? What's wrong with you? Buy a house, buy a house, buy a house, buy a house, buy a house. And then we have 27-year-old couples who have been out of school 5 years who are now hundreds of thousands of dollars in debt, plus their home, come to us And they say, Dave, can you get me out? We do not borrow money for anything, ever, in any circumstances, ever. That idea is weird. I am well aware of that. And it is such a hard job to convince people who have been sold by 4 credit card companies $4 billion a year for decade after decade after decade. You see, if you don't have any payments at all, none. Think about it. Just breathe in. What if you didn't have, even, let's just pay off your house right now in your mind. Everything's gone. And you come in Monday morning, and the boss starts yelling and screaming and cussing at you. You just start walking off. You're like, where are you going? I don't have any payments.
All right, so a couple things. One, I want to give my respect to Dave Ramsey. Like I said, he's been preaching financial literacy for a very long time, which I think is a great thing. It's a very positive thing in this world. So not to kind of, be negative about it, but I do find that his words of advice are a little bit detached from reality in today's world. They're a little old school, right? So he preaches this whole no debt, no debt, no debt. And I get it. Too much debt is bad, obviously, right? It's simple. If you think of yourself and your household as a business, too much debt, not enough cash flow, that's a recipe for failure. However, there is some smart debt out there to take, such as mortgages, some cases cars, depending on interest rates. He mentions in these videos all the time, the borrower is slave to the lender. And it's a little bit of hyperbole because, I own a few U.S. Treasuries, which makes me a lender to the U.S. government. Are they my slave? I don't think so. And I've done studies on this in the past, right? So, think about a young couple, 28 years old. They just bought their first house, $400,000. And from 28 to 38, they basically, they put all of their effort into paying off their home to have no debt. So they're not saving, they're saving minimal amounts in their 401k. They're not saving anything in the brokerage account or anything in Roth IRAs. They're not investing. That's a decade they're missing out. And if they did it in the last 10 years, they probably missed out on 200, 300% returns. Your house is not going to return that. And it's an illiquid asset. So you pay off your house at you're 38. Yeah, great. You don't have any mortgage payments. That's great. But you have this equity in a home that is what? You can't spend it. You can't eat it. And that's the things. So he comes with this, this saying, if you had no payments, so no debt payments, no car payment, no mortgage payment, would you go, you could just tell your boss to F off? I don't know about you guys. I have 2 kids. I still got to feed them. Even if I had no mortgage payment, I still got to work. Right? So it's a little bit detached from reality. I'm always of the opinion that having a mortgage, again, with rates where they are, it's probably not as attractive as it's been in the past, but still, I think it's one of the worst decisions you can make is as a young person missing out on a decade or more of, the S&P 500 or other equity market returns. That's significant, right? And in 10 years, there's a thing called inflating away debt, which is what a mortgage can help you do, right? So when you get your first mortgage, and I remember when I got my first mortgage, it feels like it's half your income, right? It's eating your house for. But after 10 years, once your income keeps going up and your mortgage stays the same, well, that debt is inflated away, especially 25 years down the line, 30 years down the line, your mortgage payment is minimal. Now, in some cases, yeah, maybe it can make sense to pay a little bit extra principal here and there if you're also saving in the other accounts and you're not missing that. But I would venture to guess that if you just ran the simple numbers of an opportunity cost between missing out on investing and paying off a mortgage, you're gonna lose, in my opinion. Now, cars are a different story. I've said it in the past. My car I bought in 2020, so I have a 3% mortgage or interest rate. I'm not paying that off anytime soon because I can beat that investing. I can. But now with 8, 9, 10% car, interest, maybe it does make sense to buy a car cash, have no debt there. And obviously credit card debt, not great. Probably the worst that there is. So he's right in some sense, but the whole no debt, no debt, no debt. Some of the richest and most wealthy people in the world, they use a ton of debt to their advantage. A ton of it. And by the way, Mr. Dave Ramsey has said in the past that he believes he's wealthy because he had no debt. Well, he also has a show. He sells courses to people. He's written several books. And I know for a fact that he has a program that sells leads to advisors that come from his show. So I think it's the other way around. He was able to pay off his debt because he was wealthy selling his knowledge and information. So again, all respect to him. No hard feelings, but I disagree with the no debt thing. I think there is ways to take smart debt for opportunity costs if you're able to save and invest the difference. So that's all I have today for today's episode. I hope you enjoyed it. It was a little bit different. That's my plan for episodes going forward, is to have a few different segments, talk about a few different topics. Again, if you have not subscribed to my podcast, you can do so by, following the link, download it on, we're on Apple Music, we're on iTunes, we're on Spotify, or Amazon Music, you name it. Or if you're watching on YouTube, please subscribe. I would greatly appreciate it. And if you're a young high earner out there watching this and, you believe that I can help you, you can always find my contact information in the show notes. You're exactly who I work with every day, just like I went over with the case study, and I'd be happy to talk with you. Have a great day.